Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, collect a premium upfront and generate consistent returns year on year. So the first thing you want to do is just open up any underlying. We've got UAL here, we've got a position open that we've been managing for some time. Unfortunately now the position is starting to move back in our favor again as of recently. So with any positions, any underlying is fine. We just want to get a list of expirations up, and we want to see where we are currently in the options cycle, and we want to lock in an expiration date for our positions, for our new positions. So the expiration date that we pick needs to be between 30 and 60 days out in time. And it also needs to be a monthly expiration, not a weekly or quarterly expiration. So the only one that fits that criteria is December 20th right now, and it's currently 38 days away. So we can take that information, come over to our watch list. You can have any watch list you want. This is just a pre-made watch list. You can make your own. It's irrelevant, and you simply want to filter out anything that has earnings over the next 38 days. Okay, and the reason for this is because earnings will have a negative effect on your P&L. It will increase volatility. It will mess up your deltas. There is a way to make money from earnings by actually making earnings plays. However, that's a separate topic. This is just for the bread and butter of your portfolio. You want to avoid earnings, and you also want to filter out anything with a low liquidity rating level. We only want to be making trades on underlyings that are liquid so that we don't have to pay wide spreads. We want to pay tight spreads, and we want to be able to get in and out easily as well. And then you'll be left with something that looks like this. I personally order my watch list from high to low IVR. You can order it from high to low percentage change. It doesn't really matter. There's loads of different ways that you can do it. But at its core, it's all the same stuff. So I like to use IVR. Anything with IVR of over 50 can be considered to be high. Anything with an IVR of below 50 can be considered to be low. There are exceptions to this rule. However, as a general rule of thumb, over 50 is good. So we just go down the list and we simply see what would fit well in our portfolio. Be conscious of what's already in your portfolio. So this portfolio that you're looking at is just a small portfolio. It's for example purposes only. And you should not be modeling your portfolio after this. For example, we've got UAL open at the moment. It's one position open. Ideally, you don't want to have just one position open at any given time. But in this portfolio, it doesn't matter. We've got Delta Airlines here that looks like it'd be great for a trade. If you had one position open in your actual portfolio and it was an airline underlying, you probably then wouldn't want to go and open a second position in another airline company in the same sector. You'd want to be looking at something a little bit different. We've got KRE, we've got GLD, we've got GDXJ, so many different things. Just use common sense and keep your portfolio diverse. So with that being said, let's have a look at GDXJ. It's currently trading at just over $45. It's got an IV rank of 54. It's got an absolute IV level of 34.9%. So we should be able to find a pretty decent trade on GDXJ. So this is now the options chain that you're looking at, and the way it works is we've got a horizontal orange line that shows you where price of GDXJ currently is with respect to the strikes here, and we've got a vertical orange bar that shows you what the expected move is of GDXJ over the next 38 days. So how do we make money from this? Well, we want to sell one call and one put to start with, and we want to sell them anywhere between 15 and 20 deltas. So we've got a 16 delta here at the 52 strike, which looks great. We've also got a 16 delta on the put side at the 41 strike. And what we've done here is we've created a range for ourselves between 41 and 52. And as we can see, our strikes, our contracts are sitting outside of the expected move. This green bar here, shows you our break even. So as you can see, our break even points are wider than the orange bar, which is the expected move, and that should lead to a high probability of profit, which we can see here is 75%. And if we wanted to get out of this position at 50% of max profit, then we've got an 85% chance of hitting that price target at some point over the next 38 days. So very, very high probabilities of success here. And we would collect $92 up front in premium. Our broker is going to require just under 1.6k in buying power. This isn't the best return on capital for a naked position. However, the probabilities are very, very high in our favor. If we wanted to go for a little bit more premium, we could simply just we don't want to open two, but we could simply just move our contract to the 20 delta instead of the 16 delta, and we will collect slightly more premium. And we can do the same thing on the put side, and we'll collect even more premium. Our probability of success does drop slightly. We still got an 82% chance of hitting 50% profit and a 70% chance of making at least a penny by the next 38 days, or at the point of expiration in 38 days time, I should say, to be more exact, to be more specific. So you can definitely manipulate this position to fit inside your portfolio to get more premium. However, what you can also do is buy another contract a little bit further out, to say $2 down. We can do the same thing on the put side as well, and that's gonna limit our loss. So before, we had a unlimited loss potential, as you can see here, and then once we buy some contracts to cover our shorts, our max loss is now defined, because it's defined by the spread between the short and long minus the premium that we collect up front, which is of course non-refundable. No matter what happens, we keep that premium. So we will collect $60 up front, and our broker is now only going to require $140 in buying power. So we've got a much, much higher return on capital, and that is at the expense of a slightly lower probability of profit, because our break-even points are not as wide now because we collect less premium. However, we no longer have an unlimited loss potential. So there is no right or wrong. It really just depends on your portfolio and what's going on inside your portfolio. If you do want to know how much buying power you should be allocating for your portfolio and for whatever the market conditions are, then we have put together a spreadsheet for you. Click the link in the description. It's free. Click on free position sizing template and it'll take you to this. And at this point, you simply enter in the size of your portfolio and then what the current VIX level is. And everything below will then be automatically calculated for you. It will tell you exactly how much buying power you should be allocating to any single undefined risk position, any single defined risk position, and how much of your portfolio you should be allocating to short premium strategies in general. So, like I say, it's free for everyone to get a copy of, link in the description. If you want to learn in more detail and see some of the more behind the scenes stuff, and if you want to be able to basically do this full time, self-sufficiently, without anybody helping you, without copying anybody, again, link is in the description. Click on EDS Premium and then get yourself signed up. Once you're inside, you'll have access to our portfolios, and you'll be able to see the positions that we're placing, how we're managing risk, how we're making adjustments, which you can use for inspiration, or you can simply just outright copy. It's completely up to you. There's also a full course inside, so we will teach you everything you need to know. No prior knowledge is required, so you can learn the theory and then see it being applied in our portfolios live every day, or every week, I should say, all in real time. And if you get stuck, it is a private community, so you can speak with myself directly and with other like-minded individuals. We're all on the same journey, and there's a 100% money back guarantee. So once you have studied the full course and followed our positions and trades for at least 6 months, if at that point you haven't been profitable or haven't seen results for whatever reason, then we will work with you for free until you do, or you can simply request a full refund. So it's completely risk-free on your part, and right now it is £1 a month to join. The price will be increasing. However, once you're in, the price is locked in for you for life, as long as you don't quit and then rejoin at a later date. So you are rewarded for getting in early. And with that being said, I will see you guys on the inside.